Most investors don't fail because they buy bad properties. They fail because they chase the wrong signals. They chase hotspots, they chase yield, they chase whatever works last cycle. And by the time they finally buy, the opportunity has already passed. If I were starting property investing again in 2026, knowing everything I know now, I would not spend more time researching. Instead, I'd spend more time filtering. And that one shift changes everything. Before going any further, I want to be clear about who this video is for. If you're watching this, I'm going to assume two things. First, you're serious about investing. Second, you don't want to waste years learning this the hard way. So I'm not going to walk through basics. I'm not going to walk through theory. And I'm definitely not going to chase whatever suburb is trending this month. Instead, I want to show you how I think about investing if I were starting today. Because clarity doesn't come from more information, it comes from better decisions. And this is where most investors go wrong. Because when people start investing, they usually ask the same question: where should I buy? It sounds logical, but it's also the biggest mistake investors make. If I could go back and change one thing about how most people invest, it would be this. They start with the suburb instead of starting with strategy. And that's backwards. Because a good suburb means nothing if the property doesn't work for you. So let me show you what I mean when I said a good suburb means nothing if the property doesn't work for you. So let's say our budget is 600,000. So we put in the numbers here, and our loan period is 30 years, and our interest rate is 6%. And we're buying this under joint ownership, and we put our taxable income so we can compute our after-tax cash flow. And let's say the annual compounded growth rate is 5%. Past performance is not a guarantee of future performance, but it's a good way to understand that the property or the area will perform over the full cycle. And for this example, our rental yield is 3.78% and the rent per week is 450. So let's have a look. So here it's telling us that the growth based on the 5% compounded annual growth rate on the first year, our estimated usable equity will be 24,000. Second year will be 49,000 and on third year it will be 75,000. Provided that the growth continue, it's great. But it will take 11 to 12 years for the property to become positively geared after tax. Now, that 11 to 12 years would cost us $100,000 to hold it before it becomes positive. Now, this is a good example of a property that has a good growth, but are we able to hold it long term? Next, let's reverse it. So let's say the property has a compounded annual growth rate of 3%, but the yield is, let's say, at 5%. So let's have a look. For this instance, provided that the growth continue, our estimated usable equity on the first year will be 14,000. The second year, it will be 29,000. And it will take us 6 years before the property becomes positively geared. And we are out of pocket by 39,000 for the whole period that's its negative. So this is an example of a property with a decent yield, but it will take us roughly 6 to 7 years before we can extract again a decent equity to buy another one. Strong growth means nothing if we can't hold it. High yield means nothing if it limits your borrowing power. And a property that looks perfect on paper is still the wrong property if it blocks your next move. So the real question isn't where should I buy? It's what does this property need to do for me over the next 5, 10, or 15 years? Until that's clear, every suburb looks interesting and every decision feels hard. I've seen this play over and over. Investors spend more than 6 months, some even 2 years researching. Then they finally buy something that looks safe, and then they realize it doesn't actually make them move forward. No flexibility, no momentum, just a lot of time gone. That's why if I were starting again in 2026, I wouldn't start by looking outward for answers. I'd start by getting the strategy right first. If I were starting again in 2026, I wouldn't ask what's the next hotspot. Instead, I'd ask three much more important questions. First, how long do I realistically want to hold this property? Not hypothetically, not optimistically, but realistically. Is it 5 years, 10 years, or long term? Because that single answer changes everything: the risk profile, the loan structure, and the suburb selection. Second, what role this property play? Is it for growth, cash flow support, or equity acceleration? Because a property without a role isn't an asset, it's a dead weight. And third, what does success actually look like for me? Is it replacing income, buying a better home later, or building a multi-million property portfolio? Until those answers are clear, suburb research isn't research. It's just noise. Once the strategy is clear, something interesting happens. The noise fades and the signals become obvious. Instead of chasing suburb, I'd focus on signals. Signals most investors ignore. Things like vacancy rates tightening before prices moved, days on market compressing quietly, stock levels falling while prices stay flat, rental pressure building ahead of growth. These don't make headlines, but they show up in the data early. This is where most investors get it wrong. They wait for price growth confirmation, but price growth is a lagging indicator. By the time everyone's talking about it, the upside is already priced in. So I'd position myself before the crowd, not chase it. Once you think this way, you stop wasting time. You stop analyzing suburb you could never afford anyway. You stop falling in love with properties you were never going to hold. And you stop second guessing every decision because the numbers are doing the thinking for you. So instead of asking, is this a good suburb? You're asking, does this property move me closer to my goal? That one shift alone can save you years of trial and error, not to mention hundreds of thousands of dollars. So if you take nothing else from this video, take this. If I were starting property investing in 2026, I wouldn't chase property. I'd build the plan first because the best investment property isn't the one everyone's talking about. It's the one that fits your strategy, your numbers, and your timeline. And once that's clear, everything else becomes easier. If this helped you rethink how you approach investing, please hit that subscribe button. It keeps us motivated creating these videos. And if you want to go deeper, watch this next video where I break down how investors actually spot opportunities before the market moves. Again, this is Gilbert, founder of SuburbsFinder. See you in the next video.